Scott Davila, and I am Vice President of Marketing and Client Relations. Today we will spend about 30 minutes on a presentation followed by a Q&A. If you do have a question, you should have a taskbar on your screen, and you'll see a caret next to questions. You can click on the caret, you'll get a drop-down menu, and you can type in your question. You can send it to us, or you can send it to the entire group. Lastly, I just wanted to remind everyone that we record these webinars, so we will be posting it on our website in the next day or so. You will get an email alerting you of when it is posted. Feel free to share it with any friends or family, and we're going to go ahead and get started. Joining me today is Tim Call, President and Chief Investment Officer, and Mark Livesay, who is Vice President and Portfolio Manager. Our agenda is on this slide, and we are going to spend the first few minutes talking about the new administration and the policies that they are proposing. Mark will cover the economy, and then at the end of the presentation, Tim will share his thoughts on market opportunities. So as I said, Mark will cover the state of the economy in a few minutes. It's positive news, providing support for the market. Another factor the market is paying close attention to is the new administration's policies. It's important to note that changes in policies can be very disruptive, especially when you don't know the details of them, and they can especially make the market volatile in the short term. Of the many changes we're hearing about today, these are some of the policies making headlines on this slide that not only could affect the economy, but also our country's government debt challenge. Today, our total U.S. debt is a little bit over $36 trillion, approaching 100% of GDP. It's forecasted to soar even further. At this current level, we are spending around $875 billion on interest payments. So if economic growth slows, then there will need to be other sources of revenues and sizable cuts in spending to be able to manage the debt responsibly. So we'll start with the first bullet point here on this slide, which are taxes. The number one priority for this new administration is to extend the Tax Cuts and Jobs Act from 2017. This act is set to expire at the end of this year. The new administration also has actually floated the idea, and perhaps you've heard it in the news, on eliminating taxes on overtime and tips, as well as the estate tax, among other things. We have no idea what will and will not get passed. That's up for debate. There certainly will need to be some give and take to fund future tax breaks. We do believe the administration will be able to get the current 2017 tax cuts made permanent. That is positive for the economy. The more money people are able to keep in their pockets, the more likely consumer spending increases and our economy grows. Tariffs, it seems like every day we hear about tariffs, about how the new administration is going to impose them on companies manufacturing products outside of the U.S. and selling them here. It is certainly being used as a political tool for now to encourage companies to move their manufacturing jobs to the U.S. Supporters of tariffs agree tariffs will generate revenue. In other words, they're going to make up for the taxes not paid from American jobs. Those that are questioning or oppose tariffs are concerned that companies will increase their price of their products to cover the cost of their tariffs. Higher prices means higher inflation. Again, we don't know how far the administration will go with tariffs and what can get passed, and what countries and what products they will pose them on. But what we do know is that the concept's not new. The first Trump administration enacted tariffs on China, and the Biden administration retained and imposed higher rates on additional products. The new administration has talked a lot about DOGE, which is the newly created Department of Government Efficiency. Its goal is to cut waste and increase productivity in the federal government. Their plan is to cut as much as $2 trillion in federal spending. And again, like the tax cuts and the tariffs, it's way too early to know how it can be done and what the impact DOGE can have. But in theory, fewer government jobs and higher tariff revenue could help the budget deficit. But we also have to keep in mind there also could be short-term pain and dislocation. The market wants the new administration to take a more business-friendly approach, shifting focus towards deregulation. It's a move that can stimulate economic growth and benefit businesses. The fight in D.C. will be over how much. Will they loosen regulations? One thing is to expect the markets to react positively to less regulations. An AI infrastructure policy was announced right after the inauguration, and it announced a $500 billion venture and investment in AI. Its purpose is to accelerate AI technology to spur further economic growth. It makes sense. The initial focus will be on constructing data centers to support AI development. Again, there's a lot of unknowns to this. But if you recall Monday's tech sell-off caused by China's progress on AI, it certainly shows the market will continue to pay a lot of attention to the development and growth of AI. So in conclusion, on paper, these policies the new administration is telegraphing are business-friendly and designed to spur growth. That is good for the financial markets. But any change can be disruptive. So in the short term, there will be uncertainty and volatility until the final rules are enacted. Now I'm going to pass it on to Mark to talk about the economy.
Thank you, Scott. We've talked about different cycles in the past and how economic, political, and stock market cycles rarely line up in the same way. Today, I will focus on the typical economic cycle, which is represented in this picture. Early stage economic activity is usually coming off of a slow or recessionary period. During this phase, economic activity accelerates, hours worked rise, and the Fed is often easing on their monetary policy. The mid-cycle often sees peaking profit margins, improving employment, and increased credit demand. In the late cycle, labor becomes hard to find and wages rise, potentially leading to shrinking profit margins. The Fed is likely to be hawkish or tightening during this time. During a recession, economic activity slows, credit contracts, and unemployment rises. And that typically gives way for another cycle to start over again. This current cycle is unique because we are seeing signs of early, mid, and late stage characteristics. The early stage, the Fed has eased 100 basis points since September. We're also seeing more credit demand, and that might be traditionally thought of as a more mid-cycle activity. And the overall low unemployment rate is more synonymous with the late cycle. We do not see signs of a recession, and some of the more forward-looking indicators for the economy have trended positively recently. One such of these indicators is the Index of Leading Economic Indicators, or LEI, which I will talk a little bit more about on the next slide. The Leading Economic Indicators Index measures things that are thought to lead economic growth or contraction. The LEI is helpful because so many economic indicators are backward-looking, so this forward-looking index is incredibly valuable. This index includes things such as average hours worked, initial unemployment claims, new orders, building permits, the stock market, the yield curve, and consumer expectations. These tend to be good predictors of future economic growth. This chart shows the 6-month change in the LEI over the last roughly 25 years. A 5% reduction in the LEI has been a relatively reliable recession indicator. As shown, the LEI dropped over 5% just prior to the 2001 recession and again prior to the global financial crisis. Remember, economic growth stagnated beginning in 2022. GDP was negative for the first 2 quarters of that year, but we did not get an official recession designation from the National Bureau of Economic Research. In the past, this may have been considered a recession, but it was not this time. The LEI index remained low for much of 2023 and 24, but has broken above the critical negative 5% level. Business and consumer confidence levels have risen. The yield curve is no longer inverted, and the stock market is signaling that animal spirits are awakening in the U.S. economy. So this is overall good news. And now next slide will talk to everyone's favorite topic of these calls, I'm sure, which is inflation. Inflation has been the #1 story of the economy since 2022. I don't think there's any argument to that. We've covered the topic ad nauseum on these webcasts. So we're taking a wide view this time, and we can see that inflation was running at roughly the 2% Fed target prior to the pandemic. During the pandemic, inflation dipped below 2% briefly as everything was shut down before exploding higher. We are currently well off the June 2022 peak in inflation, but we have settled to a level of roughly 3% higher than the 2% Fed target. We have said in the past, and we continue to believe, we do not see a quick return to the 2% target. However, much of the work has been done, and we do not think inflation will be the primary concern for the stock market this year. As such, we might not be as focused on inflation charts for each and every webcast going forward, which I'm sure is a disappointment to all, but hopefully we can get past this. Next topic is the yield curve. The yield curve is returning to a more normal shape and level, with long rates higher than shorter rates for the first time in about 3 years. So in this chart, the darker blue, which is the second from the highest, is the December 31st yield curve. Typically, Treasury bond investors demand higher interest rates for lending money for longer periods of time. When the curve is inverted, like it was during most of 2023 and 2024, in the light blue and also the green on this chart, it signals that bond investors believe economic growth will slow. So they will accept lower rates for longer dated maturities so that they can lock in those returns. That's not a healthy sign for the economy. At current interest rates, bonds with longer maturities are providing positive real returns, meaning that the 10-year Treasury rate is now higher than inflation. This is a healthy sign for the economy, so we view this as positive news. Given potential economic growth and high U.S. government debt levels, we do not expect rates to fall to the COVID and financial crisis lows. We do remain cautious on investing in longer dated bonds at current levels, as high debt levels may lead to increased rates in the future. So overall, the yield curve is painting a positive picture along with the LEI index. And next, I'm going to talk about a couple of trends that we think are investable over the medium to long term. The first is the need to build more housing. This chart shows new listings, home sales, and mortgage rates. Much of the time, sales and new listings are very close together. But following the pandemic, sales moved higher than listings for the period in the middle of this chart, you see with the green line higher than the blue. This will have the impact of lowering the inventory of homes for sale. As mortgage rates rose off historic lows, new listings fell drastically. That's the blue line. This makes sense, as roughly 2/3 of new listings are from existing homes. Homeowners with mortgage rates at 3.5% or lower did not want to sell their home and go into a new mortgage at 6% or more. Many homeowners remain in that same situation today. So houses listed for sale are well below the pre-pandemic levels. You can see that blue line on the right side of the chart is lower than it was on the left. We believe in order to bring the housing market supply and demand in more balance, we will need to build new housing units. So if people aren't putting their house for sale, we need to build new houses. An added benefit of getting housing supply and demand in balance should be to help inflation, as shelter, as we've mentioned before many times, is more than 1/3 of the CPI index. Another theme for the medium term is a return to more healthy mergers and acquisitions activity. This chart shows the number and value of global M&A deals going back to the mid-1980s. Mergers and acquisitions trends are cyclical, with peaks and troughs along the way. Both 2023 and 2024 saw the lowest number of deals since the financial crisis. The value of deals was roughly in line with the 2010 to 2013 period, when the world, and in particular the banking industry, was still recovering from the financial crisis. We believe global M&A is set to have a positive few years as pent-up demand is unleashed. We would view increased M&A activity as bullish for the market overall, and in particular for some of the companies that specialize in this type of work. It also tends to benefit small and mid-cap companies more than large caps, as they tend to be acquisition targets more often than not. Tim will have some slides in his portion with some of the specific companies benefiting from these trends, and I will go ahead and pass it along to Tim now.
Thank you, Mark. The sluggish economy's transition to faster growth will be a disruptive and bumpy ride. Exiting a period of slow or negative growth, many smaller companies can be in oversold territory. This happens to be the case today, and this results in more upside potential. As seen on this chart, since 1990, during the 12 months after an overnight interest rate cut, on average, the market has produced positive returns after each cut. In this cycle, so far, the Federal Reserve cut by 0.5% in September, another 0.25% last November, and another 0.25% in December. For the 12 months after a rate cut, on average, there were strong double-digit returns for small and mid-cap stocks, but only mid-single-digit returns for large caps. Net of inflation, that doesn't leave much for large caps. The S&P 500 is the standard U.S. large cap index, representing 500 of the largest publicly traded U.S. firms. The index holdings are weighted by their market cap. The 10 largest stocks have had quite a run, so much that these stocks represent a record 39% of the S&P 500. The remaining 490 stocks only represent 61%. Moreover, these 10 largest stocks now trade at 30 times earnings. This is nosebleed territory. And we see one of the largest valuation disparities the index has ever had, with the 10 largest firms having a PE multiple more than 10 points higher than the remaining part of the S&P 500. This is amazing, as historically, the largest companies have had less room to grow, and so they should not have the highest valuation. The last time we saw a similar trend was in the late 1990s. Four of the largest companies then, Cisco, Intel, GE, and Coke, are at lower stock prices today. It's been 24 years. That's a pretty bad return. So entry valuation matters. This is not the time to enter into the S&P 500 index. In the subsequent 10 years after those stocks peaked, in the first decade of the 2000s, the cumulative return of the S&P 500 was negative 11%, where we had clients who had their portfolios double. Disciplined, active investing can yield more attractive portfolio valuations, whereas index investors don't have a choice. Currently, they're trapped with huge, expensive stocks and a mix of others that can include shrinking firms or bad managements. Disciplined, active investors can sift through a larger pool of stocks. We choose undervalued, growing, excessive cash generators. We call these cash cows. Our approved holdings can be further sorted and weighted by dividend yield, growth rate, and size. This results in our dividend appreciation, growth in income, and small and mid-cap or SMID portfolios, as can be seen with lower estimated PE ratios, valuation multiples, than the indices. Other market participants will eventually see our company's recurring growth. The long-term earnings growth combined with valuation multiple expansion should yield strong results. Many of our approved holdings fall into additional categories that can be, these categories can boost performance. Scott mentioned investments in build out of AI infrastructure, data centers, server farms. Mark referenced overall need for residential construction. There will be an even heavier need for construction supplies in disaster areas. Destroyed properties in Georgia, North Carolina, and California will be rebuilt. Those with insurance policies will receive checks over the next 18 months. Many people will qualify for federal loans. Some will choose to sell their properties instead of rebuilding. In those cases, the new buyers will likely develop the properties. On this slide, the first three of these firms are construction suppliers. The fourth, Crawford, provides services to property and casualty insurance companies, adjusting and payments, coordination of services. Residential and commercial construction are important parts of the U.S. economy. Their growth tends to correlate with overall domestic economic growth. The financial services sector benefits from economic growth. Increased consumer and business confidence, narrow credit spreads, and fewer bank regulations should encourage more investment banking activity, like mergers and acquisitions, which we call M&A. Citigroup is a bank whose M&A arm is becoming a larger and larger part of earnings. Goldman Sachs is an investment bank with the world's largest M&A business. Moelis could be the biggest beneficiary, as it is a pure play in M&A and restructuring. In prior M&A cycles, many firms across most sectors took on debt to make acquisitions. Some took on considerable debt. Wall Street has discounted the stocks of debt-laden firms. Some are priced as if they have no future. Indebted firms that are cash cows can pay off their debt over time. The growing cash cows can pay off this debt faster. As these growing cash cows grow earnings and pay down debt, their debt ratios improve fast. Cash cows on this page all made large transformative acquisitions in the past. They are now paying down the corresponding debt. As their debt ratios improve, their stock valuation multiples should greatly expand. The combination of their earnings growth and rising PEs should generate strong results. We saw this with previous holdings like One Oak and Toll Brothers. Recently, we saw this with Pitney Bowes prior management of Pitney made large acquisitions and took on lots of debt. We became one of the largest shareholders and voted to replace the board and management. Some were replaced 20 months ago. All of the rest of the board was replaced last spring. New management has already put Pitney on a growth track. Debt is being paid down fast, and that is the right combination. Enormous returns can be generated when the firm, left for dead, exhibits recurring growth and an improving balance sheet. Pitney's stock price has tripled over the last 15 months. Every firm on this page represents a different economic industry. They paid for large transformational acquisitions with debt, and currently they're rewarding patient investors with dividends. ACO is currently at an inflection point, what we think is a sweet spot. New management has returned the company to growth. Debt is being paid down fast. Does that combination sound familiar? ACO has paid down so much debt that it can use its excessive free cash flow not only to continue to pay down debt, but also to start repurchasing shares and make small, definitely small, bolt-on, instantly accretive acquisitions, all paid for with excess free cash flow, not with new debt. As Wall Street sees this activity and sees the further progress, expect the stock to be rewarded. Gray TV took on debt when purchasing key TV stations. These stations used to be the prized assets, the crown jewels of Jefferson Pilot and Meredith. When it needed about 35 acres of land for production studio expansion, well, it bought an old 135-acre GM plant in the Atlanta suburbs and used several years of cash flow to clean up the property and to build the new production studios, which are now complete. And Gray should receive a full year's of rent from some of those studios while it uses the others for itself. Wall Street would have preferred if Gray had paid down debt, the acquisition debt instead. Well, that has now started. Wall Street also does not like how Gray's stations make excessive advertising profits during presidential and gubernatorial election years, the even years. They make far less in the alternating years, the years that end with odd numbers. Apparently, this takes too much analysis for Wall Street to figure out, but a patient investor can just use smoothed earnings. Currently, Gray's stock value is less than 2 times average annualized forward earnings. This valuation, relative to smoothed earnings, makes this growing company the greatest opportunity of my career. But there is more. 100 acres more. This unused, rehabilitated, unencumbered, extra 100 acres in the Atlanta suburbs is excess land that is likely worth more than the value of all Gray stock, its entire stock market capitalization. Our undervalued, growing cash cows span numerous economic sectors, and they should benefit from the changing economy and financial market leadership. As high valuations and top-heavy weightings hold back index returns, actively managed portfolios selecting stocks using time-proven best practices should be rewarded. Our disciplines include quantitative screening, fundamental analysis, and requirements for expected return or valuations. From housing to financials and industrials to broadcasting, collectively, our best ideas represent diversification by size, sector, and sub-industry. Mutual funds might contain 200 or more stocks. If they have best ideas, each of those might represent 1% or less of their fund. Our clients deserve better. Our portfolios consist of our best ideas. When a stock doubles or triples over 1, 3, 5, or 10 years, it has a meaningful impact on the portfolio and on client wealth. Along the way, there will be volatility and market corrections. Yet, we will remain steadfast, adhering to our investment disciplines. We will be patient while others follow the herd's emotions, and we will stay on top of each of our companies. We are focused on the long-term compounding of results, and we are excited about the future. Scott?
Thanks, Tim. Well, that concludes our presentation part, and we're going to jump right into Q&A. We've already gotten some questions. The first question is, Tim or Mark, do you see another big sell-off like we had on Monday?
Well, this is Mark. I think by definition, you don't see those coming because if they were not a surprise, you wouldn't have a big sell-off. So it's hard to predict big sell-offs like that. The one thing that we are very cognizant of is that every year the market sells off on an average basis. It probably sells off 10% during a given calendar year, and that's completely normal within the fear and greed emotional swings of the market. So there's nothing that's obvious on the future for the economy that would say the market has to fall a lot. I think the things that we've been pointing out, that the over-concentration in essentially one sector and one size makes us nervous. And Monday we saw one of the largest companies, NVIDIA, was down, I believe, 17% for the day. And so that is certainly possible with the market being so over-concentrated that some of those names might have a bump in the road when expectations are very, very high and PE ratios are above 30 in some cases. You could see that happen, but there's no predicting volatility, but we do know it will happen, and we're comfortable with it, and that's how we compound it. Nice returns over long periods of time is being comfortable with that volatility and living with it.
And on Monday, many of our stocks happened to be up that day, while NVIDIA was down 17% or more intraday.
Okay, thanks, Tim. Thanks, Mark. Next question is, Pitney Bowes has seen some significant capital appreciation in their stock price over the past year, which is great. However, that has diluted the dividend rate. Other dividend-paying stocks have also seen gains with depreciation of dividends. How do you deal with this for investors who are focused on dividend yields?
So our portfolio weightings, depending on the style you're following, whether it's dividend growth or growth in income, they'll weight the stocks differently, and dividend yield is one of the factors. And so, yes, in the growth and income portfolios, the dividend yield falls because of the stock price surging ahead. Well, those stocks we would want to trim, especially as they approach their price targets. We do tax managed accounts, so in taxable accounts, we might trim at a slower rate, or we might make offsetting trades so that not too much tax liability is incurred.
And the other thing I like to tell people is the dividends in dollar terms have not gone down. So when the price goes up, the yield goes down on a new dollar of stock purchased, but the yield that we purchased on behalf of you really does not change, even if the price of the stock goes up. So it's just kind of another way of thinking about it. It's not as if your dividend income is declining. It's just that if you purchased that stock today, you would have a lower yield than you did when you purchased it at a much lower price.
Thanks. Another question we have here is, do you think the REIT space, like service properties, will improve anytime soon? Space has not been performing well.
So there are different segments of the market, and there can also be special circumstances. So you can split up the REIT market usually in many subcategories, and a lot of commercial office space should continue to be weak, while other areas perform with the economy. And with our company Service Properties, over half of it should do well with economic growth with their hotel base, 1/6 with more of a strip mall base, and then the last third is rather stable, at least British Petroleum or BP, with a whole lot of truck stops. And they are selling off unprofitable or low margin properties to pay off debt. So when you sell an unprofitable property, well, that helps earnings. And when you use the cash proceeds to pay off debt and no longer have to pay interest on that debt, well, that helps earnings too. And paying off that debt lowers your overall debt. So your debt ratio, your earnings related to the level of debt, those improve greatly. And so that is a special circumstance. And we think most of the money in REITs will be made from special circumstances, not from property prices advancing.
Thanks. One more question here real quick. The market reached new highs last year. Should we be thinking about being more conservative with our investments, like bonds?
Yeah, so I think we believe that we are pretty conservative in all of our strategies. We had a slide earlier in the presentation showing the PE ratios of the top 10 stocks in the S&P and also the S&P 500 overall, and we're well below that in every category. We also, depending on your strategy, might have a very high percentage of dividend yields, as we kind of just talked about with Pitney. So we feel like we're being conservative. The way we manage money has not changed in the 15 years I've been here, and we like to have what we call all-weather portfolios, so we can do well in a good market, but also do much better in a down market. So we feel like we're well prepared for that and don't need to become overly conservative. If you have and Tim has done a great job talking about this in the past, if you have buckets of money that you know you need for spending in the short term, then it's likely that you should be in cash or maybe a short-term bonds portfolio for that section of money. But for your growth assets, I think we still believe that stocks provide a much greater long-term opportunity than bonds do at this time.
So we've had strong markets, and some stocks we're approaching their price targets. Maybe some stocks have exceeded their price targets. Well, if you're in the index, too bad. They now represent a larger part of the index, so a larger part of your portfolio, and you're stuck with those very high valuations and risk. And we agree that is very risky. When some of our stocks approach their price target, we can trim and sell those stocks. And we tend to do it in a tax-efficient manner. And then we replace them with undervalued companies that are growing and have strong fundamentals. So we agree. We see the same risk, and where we saw the risk in our portfolio, we sold that and replaced it.
Thanks, Tim. Thanks, Mark. I think I got to everyone's questions. If we did not, we'll try to get to them after this call and email you individually. Once again, I want to thank everyone for attending today's webinar. As I mentioned earlier, we have recorded it and we will be putting it up on the website in the next day or so. Again, thank you for attending and have a great rest of the day. Bye.
Thank you.